In this lecture, I'd like to talk about applying supply and demand analysis to help us understand financial market bubbles. What is a bubble? Well, surprisingly, there's a lot of debate among academic economists and financial economists about whether bubbles even exist. But if we assume that bubbles do exist, they're prices or price patterns that cannot be explained by normal economic forces. Here's some of the things that economists think that they understand about bubbles. They represent expectations about the future. And these future expectations play a key role in keeping bubbles going. For instance, if buyers expect a future price increase, this will create an incentive for them to accelerate their purchases in order to avoid that price increase, or at least make their purchase before the full effect of the price increase has occurred. On the other hand, sellers will tend to delay taking advantage of it. You can imagine whether you own a share of stock or whether you own a piece of real estate. If you expect that the price of that stock or real estate is going to go up in the future, all else equal, you're going to be inclined to hold on to that and wait to sell it until the price increase has occurred. Both of these behaviors, the incentive to accelerate purchases and the incentive to delay sales, increase the price. And in many regards, the expectations become self-fulfilling. As investors expect price changes to occur, that expectation leads to exactly the behavior that in fact makes that price change occur. So, for instance, when buyers expect prices to increase faster than the interest rate, then it makes sense to borrow money. It makes sense to borrow money and use that borrowed money to expand their buying now in order to sell in the future. After all, if they can earn a higher return than their cost of funds, they'll be able to make money and have extra money left over even after they pay off the loan that they've taken out with interest. This contributes to an increase in demand. If we consider this example or this illustration of the price of an asset on the vertical axis and the quantity of the axis on the horizontal axis, the initial equilibrium is occurring at the point where D1 and S1 overlap. If there's an increase in demand on the buying side, again, it could be simply a matter of expecting a future price increase, and that expectation leads buyers to accelerate their purchases. The very act of accelerating purchases will increase demand, which we'll model as a rightward shift from D1 to D2. And that rightward shift actually has the effect that it increases the price today. Likewise, a seller who expects that price to increase will delay the sale of their asset. How do we model fewer sellers in the market? By a leftward shift or a reduction in supply. S1 shifting to S2. Well, if we follow this chart, we can see that going from D1 to D2 raises the price, but then going from S1 to S2 raises the price further still. When investors disagree about the significance of a particular economic development, that's a time that's particularly prone to financial bubbles. One of the reasons is because it's more costly to bet on prices going down than it is to bet on prices going up. For instance, if I think that the prices of houses are going to go down, if I own a house, I could sell it, but it's difficult to sell a bunch of houses that I don't already own. On the other hand, if I think prices are going to go up and I'm able to obtain the financing, I could buy 1, 2, or even many more houses. The same is true with stocks. If I think that the market is going to go down, I could sell the stocks that I have, or I could even borrow some shares from other investors and sell them, a process known as selling short. But there are limits to how many shares I can sell short that are stricter than the limits on how many shares I can buy if I go long. So if I think the market is going to go up, on the other hand, I can buy as many shares as I have capital to do so. The net effect is that bullish investors with optimistic views of the future, tend to dominate the bearish ones. And this creates more upward pressure than downward pressure. And so it's more likely for financial bubbles to begin to build in an upward direction. Another characteristic of financial bubble periods is that they are marked by huge increases in trading volume. Almost every historical episode that can be characterized as a financial bubble has seen dramatic increases in trading volume that accompany the increases in the prices of the assets. One of the reasons that bubbles tend to persist is that no one investor typically has the financial or economic firepower to successfully attack them. It's only when skeptical investors act simultaneously, which is a moment impossible to predict that the bubble will actually pop. For instance, the U.S. housing market experienced a dramatic bubble in the late 2000s. Between 2004 and 2007, that market peaked. Now, this was in part because in 1993, the United States government began encouraging or put in place some policies encouraging a number of low-income individuals to buy houses. One of the ways that they did that was by reducing some qualifications for borrowing from government-sponsored lenders like Fannie Mae. So there was a period there where policies were put in place that made it easier to buy a home, easier to take out a loan for the home. We can see, if we line this up with the prices of houses, that that was one piece of the puzzle. That was one aspect or one event that may have contributed to the increase in housing prices in the United States that started roughly that period of time. So there was a big economic development, and that was one element, that was one ingredient, if you will, in this financial bubble. There were others, which were relatively low interest rates that were deliberately pursued by the United States Central Bank. But I think it's also important to bear in mind a longer historical perspective. So here, if we go back to 1965, we can see that actually home ownership rates peaked in the early 80s and then declined until about 1995, then increased again dramatically. However, it wasn't simply the case that the increase in home ownership rates led to a financial or housing price bubble, because if that would have been the case, we would probably have seen a smaller bubble developing in the late 1970s and early 1980s, which we didn't see on a systematic nationwide basis. So we can see that home ownership rates, when taken in context, we weren't starting from a low water mark in 1993 and then just increasing from there. There were other periods of time where home ownership was actually subsidized and encouraged by the United States government and didn't lead to a housing bubble. So in this case, I think it's fair to say that it was an element and it was probably a necessary ingredient, but I don't think that it can be, the entire cause can be attributed to the increase in home ownership rates that began in 1993. Okay, but if we think about what did happen, housing prices increased dramatically, and they increased dramatically over this period, particularly in areas, geographical areas, where supply was relatively limited. Say areas with strict zoning laws, zoning that made supply less elastic or price sensitive, so they had a steeper supply curve, which tends to amplify any price increase that occurs when the demand increases. In addition, many investors expected prices to continue to rise. As a result, they continued buying, and many lenders didn't seem at all concerned. In fact, there was a process known as securitization that was taking place. Lenders would make a loan, bundle a number of loans together, and sell them to investors in New York, London, all over the world. One real estate broker in Palo Alto, California, in the early 2000s described it this way. He said, "We would make any loan that a New York hedge fund was willing to buy, and the New York hedge funds were willing to buy any loan that we would make." Now, Different market analysts disagreed on the interpretation of what was going on. For instance, David Luria believed that housing prices and the price increases could be explained rationally as a function of low inventories or housing stocks, low mortgage rates, and favorable demographic changes caused by a big increase in baby boomers and retirees, many of whom were buying second homes. On the other hand, economist Robert Shiller was wary of a bubble. He identified the bubble by noting that housing prices were becoming very expensive relative to rents. So he would look at the price that a house would cost and the associated monthly payment to take out a loan to buy that home and compare it to the average rent on a comparable home. In the long-run equilibrium, Shiller argued, homeowners should be indifferent between renting and buying the home. The price-to-rent ratio, here presented by Robert Shiller, shows the relative price of a home, or the cost of owning a home in terms of a monthly mortgage payment, relative to the cost of renting the home. And we can see that there was clearly an imbalance here that took hold in the late 90s and peaked right about 2006 when Shiller published a book, The Subprime Solution. Interestingly, this was not simply a phenomenon in the United States, and this is a second reason why we can't attribute the housing bubble simply to an act of U.S. Congress or a particular housing policy pursued by a particular party in the United States. If we look across the globe over this period, in fact, housing bubbles were building and growing in many countries. In fact, in many countries, much more dramatically than in the United States. In fact, the only country or one of the few major economies where this didn't occur, and one of the few that it didn't occur, was Japan. Mainly because Japan was and still is recovering from a gigantic housing and financial bubble that occurred in Japan in the late 1980s. But if we look here, Spain, Ireland, Canada, the UK, and the US all experienced dramatic price increases. All of those were attributable to a number of underlying economic forces. And while it's true that home ownership policies in the United States do affect prices domestically, it's a bit of a stretch to argue that they were affecting the prices in all of these countries simultaneously, when we can see that some countries were experiencing much larger price increases than those in the United States. So it's not difficult from that previous slide to envision the bubbles that were emerging in many of these countries. Why did they pop? Well, if you believe bubbleologists or economists who study and believe in bubbles, like Robert Shiller, it was the case that some investors started betting that housing prices would fall, and as a result, that became a self-fulfilling prophecy. But the truth is that we don't really know. We don't really know what causes financial bubbles to form entirely, and we can never predict, even in hindsight, we can never fully explain what it was that caused the financial bubble to pop. But if there were enough skeptical investors, that would certainly help, because they would start betting on housing prices or stock prices to fall, and that would lead them to actually start selling the houses, which would increase the supply of the houses, or increase the supply of the stocks and start a downward price movement that in and of itself might become the new self-fulfilling expectation. Now, Professor Shiller also predicted the tech and internet bubble in 2000, and in that case he identified the bubble by looking at the long-run equilibrium relationship between stock prices and earnings or profits. Shiller argued that if prices are rational, they should equal the discounted flow of future earnings. Obviously, we can't observe future earnings, so what Professor Shiller did was he plotted the current stock price against a 10-year trailing average of past earnings. And if we update his analysis using a 10-year trailing average of earnings, we can see that the long-run average ratio in the United States is about 16, which means that on average a stock's price is about 16 times its trailing 10-year earnings. Or equivalently, if you hold a typical stock for 16 years, the earnings will cover, on average, the purchase price. We can see as well that in this graph, there are a number of periods where stock prices went well above and well below the long run average. In fact, the two times that stand out dramatically are 1999, near the right-hand side of the graph, and 1929, just left of center. Both of those episodes were followed by spectacular stock market collapses and ensuing economic recessions. This is a very useful graph, useful figure, and Professor Shiller updates this monthly on his website. So if you're interested in doing a little bit more digging, I'd encourage you to look into Robert Shiller's 10-year trailing earnings, price-to-earnings ratio. It's one of the best measures of the relative position and the relative valuation of the stock market at any point in time. I want to thank you for listening to this lecture on supply and demand and how simple supply and demand analysis can help us to understand the fundamentals of financial market bubbles.